Imagine buying a home and paying it off over 50 years instead of 30. That means smaller monthly payments. Sounds good, right? But if I told you there are major trade-offs, slower equity buildup, more interest, and possibly hidden risks, whether you're a first-time buyer, investor, or planning for retirement, this could change your strategy for better or for worse. Stick with me because we're diving into the 50-year mortgage proposal, what it really means, and how to decide if it's right for you. The conversation around longer-term mortgages is heating up, thanks in part to Donald Trump's recent comments. For many Americans, monthly payments are too high. A 50-year term may seem like a relief, but before jumping in, you must understand what you gain, lower payments, and what you give up, equity, flexibility, total cost. This is especially important if you're an investor or someone building wealth through real estate. The term you choose impacts your entire strategy. If you're new here, welcome to the Mortgage Café with Angelica, where we break down real estate loans and smart strategies in plain English. I'm Angelica Obregon with Key Mortgages, your go-to loan officer for home buyers, investors, and families ready to make informed moves. If you ever wonder whether long-term loans like 50 years are a smart move, hit that like button, subscribe, and leave a comment below with your guess. Good idea or bad idea for a 50-year mortgage? Let's lay it out. A 50-year mortgage means you amortize your loan over 50 years. So your monthly payment drops compared to a 30-year loan, all else equal. For example, on a medium price home, $400,000 with certain assumptions, payment might drop from $2,200 30 years to around $2,000 for a 50-year mortgage. Why now? Because housing affordability is under pressure. High prices, rising interest rates, older first-time buyers. The idea? Give more time to pay to lower monthly costs. So what could be good about it? You're going to get lower monthly payment, so stretching the term means less paid each month. Possibly more cash flow or affordability. More accessibility for buyers with tighter budgets. This might open doors sooner than waiting to save more or reduce the debt. Strategic flexibility. If you lock in a home now with lower payment, you might position yourself better for future appreciation. Maybe refinance later. So yes, for some people, this could help. But here's where the warning lights go on. Slower equity accumulation. Because you're paying over 50 years, much more of your payment early on goes to interest, not principal. For many homes, it could take 30 years before you've built $100K in equity. Higher total interest costs. Over the life of the loan, you may pay hundreds of thousands more in interest compared to a 30-year. Example, a $750,000 versus a $400,000 in one analysis. Longer time to own outright. If you start at age 40, a 50-year term will stretch to age 90, which is beyond typical life expectancy. That complicates retirement, inheritance, and downsizing. Market and policy unknowns. As of right now, this is just a proposal. Legal legislative changes needed. It isn't guaranteed. So, if you're an investor, this matters in a different way. Investors care about cash flow, equity growth, exit strategy. Stretching a term to 50 years may lower your monthly payment, but it could also slow your equity growth and lengthen time before you own the asset free and clear. It could tie up capital longer. If your strategy is to buy, hold, refinance, repeat, a longer term may reduce the option. Now, on the flip side, if you're buying for cash flow and plan to hold longer without worry, maybe the lower payment is a benefit. The key is aligning term with strategy. Now let's do a quick poll. If you were buying a home right now, would you prefer a lower payment for longer term, 50 years, or a higher payment but faster payoff, 30 years or less? Comment below, lower payment or faster payoff. I'll see your answer and we'll discuss in future videos. Here are some questions you should ask yourself. What will monthly payment be compared with a 30-year? How much interest will I pay over the full term? How much equity will I build and how long will it take me? What's my strategy? Do I plan to refinance, sell, or hold long-term? Are there prepayment penalties or restrictions? Are rates higher because of term? How does this fit my retirement and estate plan? Being neutral means weighing both sides, not just chasing the lowest payment. Since this is still a proposal, some things to monitor. Will government-backed entities like Fannie Mae and Freddie Mac guarantee a 50-year term? Current law limits their backing to 30 years. Will interest rates be higher because lenders see more risk? Many expect yes. Will longer terms push home prices up because more buyers can qualify, but supply is still limited? Could reduce affordability in a different way. Will you be locked into a term that doesn't fit your life stage? If you buy at 40 and finish at 90, does that align with your goals? These are big picture items, not just numbers. So here's the takeaway. A 50-year mortgage could be an option, offering lower monthly payments and more accessibility. But it comes with serious trade-offs. More interest paid, slower equity, longer debt burden. It's not inherently good or bad. It's about whether it fits your personal or investment goals. If you'd like to dig deeper and see whether this kind of term could make sense for your situation, visit mykeymortgages.com or click the link below to schedule your free strategy call. That's your sip of wisdom from the Mortgage Cafe with Angelica, where we turn home finance clarity into confident decisions. See you next time.